right, everybody. We are ready to go. Get in, get your notebooks out, get your charts open, get strapped in. It's about to go down. Alrighty. Let's do this then. Share my screen. And let's get this party started. So let me know you guys can hear me loud and clear in the comment section. Cool. Hello. Thomas or Joshua, sorry, Gerard, Natalia, Priscilla, Reggie. I think that accounts for everybody on so far. If you're on and, well, if you're registered anyway, just let me know in the comment section. Right, so Reggie, look at your trade. It did well, didn't it? As a scalp. Anyway, let me see now. Let me stick on. For those of you who are in here, we had a session this morning at 11 a.m. We looked at a trade. There you go. That's what I'm talking about. There we go. There we go. And you see how if you frame the trade correctly, it makes perfect sense. Because let me just stick your, let me see now. Let me stick your indicators on the chart again. Let's see, insert indicators. Actually, no, one trend. So Bollinger Bands. And you also used, if I remember correctly, stochastic, right? There we go. So, yeah, so that is a signal. Nicely done. But you see that as I hope I showed you what really drove it. This indicator just helps you see something. But when your signal lines up with institutional order flow, there, so it was actually there. All right, yeah, that's a good scalping strategy. Just keep in mind that you need to understand the institutional order flow and how it's working. So I'm going to save this as a template. Save template. I'm going to save it as Reggie's strategy. So next time I want to see what you're looking at, I can just bring it up on the screen. Cool. Okay, similar setup is, I see what you mean. This one here. Okay. Let's get through tonight. Why don't you and I get together at some point tomorrow for about 20 minutes and we'll look at it. But if you want the advice, let me see now. So let me see. So we've had first of all, what's the day done on the daily? So on the daily, according to your strategy, not mine. I don't trade with indicators. It's oversold and okay. Let's see. 4 hour. Okay. Let me see. Let me add another insert indicators, custom KPI. So this 4 hour candle is going to close in 34 minutes. See, this is the thing now. It's in what I would call an indecision zone. So this is the kind of trade I would not take because there is another order block that's formed there. And so I would want some clear direction whether or not it's going to, I would want to see a 1 hour engulfing either in this one or maybe now it's going to come down like we discussed the last time. This could be what sends it down here. Also, your stochastics haven't crossed yet anyway, so when they cross, you'll know. But anyway, so this is Reggie's template. It ain't mine. Ready strategy. Yep. And now I can. Oh, that's so much cleaner. Right. So today we're looking at order blocks. And ready, because you were the one who engaged today, I'm going to use your charts to teach. So every day, whichever student engages, I'll use the charts to teach. Now you've been hearing us talk about order blocks, order blocks, order blocks, order blocks. But you probably also heard me say that an order block is one of several liquidity profiles. Let's put that in there, text. So we call them liquidity profiles. Now, what do they mean? Because many of the words we use in the course or our mentorship forums, our mentorship settings, are words that we usually me or sometimes talk about coined over time. Especially if it's something that we figured out to a degree ourselves. Don't get twisted on the words. Yeah, Priscilla, you need to recap this morning. Very, very important. Don't get twisted on the words. You need to understand what we mean when we use the words. So when I say liquidity profiles, this is my phrase for the record. I am talking about chart patterns, areas, or elements. So stuff you see on a technical price chart that tells you there is a pool, P-O-L. So let me put that there. Chart areas, patterns, or elements that strongly suggest there is resting. Strongly suggest, let me put this in there. So chart, yep. Strongly suggest there is resting liquidity at a price level. So in essence, something that you see on a chart that tells you there is a significant amount of liquidity in this area. And if you haven't already watched the Forex Foundation's video, please go and watch them on the YouTube channel. We made it very clear that price is driven by liquidity. The markets do not respect our indicators. They don't respect even necessarily our Fibonacci's. All they are indicators that strongly predict where price levels, what liquidity levels may be. Price respects liquidity. Why? Let me repeat this. Market makers have billions of dollars to feed a field of orders. They're not trading a $5,000 account. They have $150 billion in their account. They're probably trading in the millions per trade. And so they need, if a market maker wants to buy, he needs someone to sell. If you and I want to sell $100 into euros, we're going to find somebody every day of the week, any time of the day, who wants to make that trade. When a market maker wants to find a counterparty to their trade, counterparty means if they're buying, they need a seller. If they're selling, they need a buyer. They either need another market maker or they need a large number of smaller traders whose orders together make up what they need. So I'm going to introduce you to the term order book. Now, an order book simply is the the sum or list, sum and or list of all the orders a market maker has open or pending. And so they need liquidity to fulfill their order book. Market maker has open or pending. What's wrong with this thing? Right, let's try this again. Maker has open or pending. In essence, they need huge amounts of liquidity to get in and out of their orders. So this is why I said trading like a market maker is about learning to spot an elephant running through your garden. There's no way an elephant can tiptoe through the garden without letting you know it was there. So there's certain things you see on a chart that an inexperienced trader will overlook, but an experienced trader will say, somebody with deep pockets has orders there, or someone with deep pockets is engineering liquidity. So they are tricking someone else, either one other person with big orders or several people with small orders, into doing something that generates liquidity for them. We've shown you the manipulations, the stop hunts, and everything. So how do you spot liquidity on a chart? You look for liquidity profiles. What is a liquidity profile? It's a chart area, pattern, or element that strongly suggests there is resting liquidity at that price level. In essence, if you see, for instance, I'll give you an example. There's one here, and I'll talk to you about it in a second. This formed on the 30th of June. The fact that this formed here means moving into the future, there is likely to be liquidity at this level in the future. So a whole week later, this liquidity profile here tells us there is likely liquidity resting at this level. That's what I mean by at a price level. It doesn't just tell you there was liquidity in that on that day or that time frame in that time. Moving into the future, it suggests there will be liquidity at that level in the future. You got to bear that in mind. Now, how do you spot liquidity on a chart? Well, the first thing you know is liquidity causes price to change direction. So let's write that down. Signs of liquidity okay. Number one, change of direction in price. So if something causes price to move the exact opposite way from where it was moving before, it's a sign that price ran into a liquidity profile. Second sign of a liquidity profile, or that there is liquidity somewhere, is a consolidation. It means price is hanging around an area too long. It doesn't want to move away from that area. It keeps, or it could be that every time price moves away from that area to one direction or the other, it keeps coming back. These are all signs of liquidity. Number three, is sudden injections of momentum. So if price was just, moving along very nicely, slowly but surely, and then even if it's moving in the same direction, it gets to a level and it just runs away very, very sharply, it is a sign that there is probably a significant amount of liquidity in that area. So let me know if you understand me so far. Let me know if you're with me so far. If you have any questions, because I really need you to get this. This is one of the foundational pieces of the course, so I'm going to take my time tonight. Do you understand me so far? So liquidity profile suggests there is a chart area pattern element that suggests there's liquidity resting at a particular price level. Market makers need liquidity levels to fill their order book. And the signs of liquidity are 1, a change in direction of price, 2, a consolidation, or 3, a sudden injection of momentum, meaning price was just going along nicely and then it starts to run crazily. So let's look at this chart so far and see if we can spot any of these. And I have a list of these, but before I give you the list, I'm going to just show it to you. So I'm going to build the list as we see it in price. That way you don't have a theoretical list. You have something that you understand as practical. So number 1, highs and lows. Why? Because when you see a high, something caused price to change direction. When you see a low, something caused price to change direction. You don't always need to know what that thing is. Sometimes it's very obvious what it is, but you don't always need to know what it is. You just need to understand it ran into an area of liquidity. So number 1, liquidity profile, obviously, highs, or should I say previous highs and lows. That's why if you notice, when I start trading for the week, I showed you guys my process over the weekend. I go through on a daily and a weekly chart and I start marking highs and lows going back anywhere up to 3 months. Why? If something changed price at that level in the past, it stands to reason that it will move again or it will affect price again in the future. Why? Because market makers, remember we looked at introduction to the market maker philosophy. Market makers are position traders, meaning their orders or their trades or their setups occur over long periods of time. Therefore, something that was significant 3 years ago could still be significant right now. That's just the way they work. So highs and lows. Number 1, liquidity profile. It seems very simple, but it's very important. So highs and lows. Now, so we see high. Now, number 2 are things we call zones. Liquidity zones or order blocks. So in essence, when we refer to an order block, we're literally talking about a zone of liquidity. So number 2, liquidity zones, aka order blocks. Now, why do we call them order blocks? Very simple. I will show you. Which low do you go for in this case? The high seems a bit obvious. Reggie, I'll answer that question. I'll answer that question later on. At the moment, I'm not talking about picking a trade. I'm just showing in general the concept of liquidity profiles. So right now it's not necessarily important to know which one will work. I'm just giving examples of them. So number 2, liquidity zones, aka order blocks. Now, the reason we call them order blocks is if you come back down here, we spoke about an order book. So a market maker has a portfolio of trades they are in or want to be in. They're called orders. For instance, if you come to your MetaTrader, even see here, you open a trade either at market execution or pending by placing an order. So an order block is a liquidity zone that tells us that a market maker placed orders there. That's what it is. It's a block in which there are orders. Price was going up. Now, in the past, let me give you an example. You see that level there? That was probably caused by this here. So this order block from here, okay, no, not that one, this one. This order block from here is what gave rise to that level there. So this is coming into an order block from the 9th of June. However, once it does that, so it stopped here because it's in an order block from the past. However, once it stops there and comes back down, that last candle before the change of direction historically has been proven to mean that somewhere in that region there are significant orders placed, bearish orders placed. That's why price reversed. There is liquidity resting in this zone. So it's called an order block. The principle now is whatever drove this out the first time, it is very unlikely that a market maker fills their order book in one move. So let's assume they put $50 billion worth of orders there. When it moved out the first time, perhaps they only got 25 billion filled. In essence, there's an extra 25 billion that day. And remember, Forex is a $5 trillion a day market. The prices are eye-watering. So it is very unlikely that this first time they got everything they needed, which is why price will usually return and then pick up the remaining orders. And then you get this. And sometimes it needs to go back a third time because it's still not picked up all those orders. This is called an order block because there are orders in there. It's a block that has proven to have bearish orders. So it's called a bearish order block. Let me just put this here. So number 1, we spoke about highs and lows. So number 1, highs. Number 1, highs. Number 2, lows. Number 3, order blocks, aka, let's reverse the aka liquidity zones. So this is an example of a bearish order block. The reverse is true. Let me give you an example. This right here is the same principle that happens here. 1 second. So this one there. Yep. So Price was going down, comes back up. I'll just take this whole thing for now. Something pushes it strongly back up. The next time it comes down into that region, the orders could be anywhere from here to here. Let's assume there's 100 million orders worth of orders in there. There could be 5 there, another 5 there, 20 there. You don't know where in the zone, but somewhere in that zone there are significant orders. Not all of them have been picked up. For instance, here, to move from here up here, some orders were picked up. To move to here, some orders were picked up. Every time it moves, and you see sometimes it comes back down because it needs more orders from that region. If it just keeps going, it means all the orders in there have been satisfied. However, it could come back down. Sometimes it could come back down weeks later. That's an order block. It's a block in which we now know that there are significant orders resting. So that's the second liquidity profile. Right. Now, the third liquidity profile, which is not common to most people who trade, so people don't understand that this is a liquidity profile. I call them price action pivots, aka organic pivots. I have to define the word pivots because most retail traders define their pivots by mathematical formula. I have even forgotten the formula because I haven't used it in forever. But there's a formula for finding pivot levels on a daily basis and a weekly basis, and people will do the mathematical calculations using the high and the low of the previous day to find the pivots for today. Half the time they're wrong. Why? Because price action doesn't understand a mathematical calculation. The orders don't move because you calculated 2 prices from yesterday. Price only respects 2 things, remember. Previous price levels and significant time periods. Price respects 2 things. Price levels and time. Certain significant times of the day, week, month, and year. Everything else is irrelevant. So how do we spot an organic pivot? The answer is simple. Look for an area of the chart where price has historically congregated. Areas where price seems to return to many times both ways or spend significant amounts of time at. I'm going to open another chart to show you this because this is getting a bit messy. Let me use one from the past. Okay, so I know that has something. Okay. Right, let's find a clean chart that we don't have anything written on. Okay, this will work. Right, so let's look at a daily chart. I want to draw your attention to this price level here. I'm just going to pick one randomly. Okay, so I'm going to pick that one. One second. This one here. I want you to see what happens at this level across this chart. See how many times price touches it. One. Two. Three. Four. work down 4, 5. I'm going to quit writing because this is slowing me down. 6. You get the point, right? Do I need to show you all the rest? You can see them yourself, right? Of course, there's a 7 and an 8 and a 9 and a 10 and 11 and a 12. This is an example of a pivot, an organic pivot level. You don't need a calculator. And no one taught me this. This is something I figured out by myself, staring at charts. You don't need a calculator. You just need to see which areas does price continually get attracted to in both directions. It acts as the same level acts as support and resistance several times over time. You can have daily pivot levels, 4-hour pivot levels, whatever it is. When you see this on the chart, so for instance, if you had seen 1, 2, 3, 4, 5, 6, 7, 8, 9, and then price comes back there, did you need to be a prophet to understand that something significant could happen in that level? The answer is no. Why does price keep getting attracted there? Because there is more than likely liquidity being released into the market or taken out of the market at that level. Why? A market maker seems to have made up their mind that that is a significant level to do business at. So, okay, if you draw it from the top to the bottom there, I'm going to skip the wick of that candle because we're on a large time frame. So let's use the bodies. As you can see, 1 second, there. This is pretty much near 50%. So it's pretty much the 50% fib level. That's not uncommon, right? But that's a pivot level. In essence, in the future, when price gets back there, we expect something significant to happen again. Let me know if you understand that. So that is another kind of liquidity profile. Number 4. What I call, again, doesn't matter what you call them as much as you understand what they are. I'm just using my terminology here. I call them momentum gaps. Gaps that are formed by momentum in price. For instance, there's a clear example on the daily EU chart that I've shown you guys several times in the last year. Is there anything on this chart? No, not good. So come to the daily chart in EU. Actually, sorry, the weekly chart on EU. This here is an example of a gap. Now, these profiles work on all time frames. You see order blocks on all time frames, highs and lows on all time frames. You see, for instance, this is an example of a weekly pivot level. That's a weekly pivot level. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, pretty much 12, 13, 14, 15, and it stays there for a long time. 16, 17, 18, 19. So you can see that you can have pivots at all levels, highs and lows at all levels, order blocks at all levels. This is an example of a weekly order block. So none of these profiles is restricted to any particular time frame. You will learn later on how to use profiles from one time frame in another time frame, because as you come down in time frames, the profiles from one time frame become very significant in the lower time frame. But we'll come to that later. So you could have this gap on a 1 minute chart, a 5 minute chart, a 15-minute chart. But this is an example here. When you see this, what it means is somebody with deep pockets was so eager to get the party started that price skipped a level or several levels. Supply and demand means that price is supposed to trade efficiently, meaning the price of a thing goes up gradually from 9 to 10, 10 to 11, 11 to 12. Because as people keep buying, they keep increasing the price. If the demand is so high that the price jumps, because this gap that looks so small there is actually 32 pips. That is absurd. And actually, it's not 32 pips because the gap is from the close of 1 week. This week closed here, right? This week closed here. Not there, it closed there. You would expect to see the open of the next candle form at that same level. No, the next candle opened up here. So that's a gap of 170 pips. Someone was so eager to get price moving, or something affected price so much, there was such a liquidity injection or withdrawal from the market that price jumped 170 pips. Just draw a line there and wait for it. Now, this is a weekly chart, so it takes 3 years. On a daily chart, it could take 3 months. On a 4-hour chart, it could take 3 weeks. On an hourly chart, it could take 3 days. Whatever it is, you can bet your bottom dollar price is coming back there at some point to close the gap. There is unsatisfied liquidity here. In essence, price moved too quick for a market maker to get all their orders filled. And you will see this as we go along this tonight and in part 2 and 3 of liquidity profiles, that when 2 or more liquidity profiles overlap, it is powerful, because there is an order block. Can you see that? That's an order block there. And in fact, if you want to refine it, that's the micro order block there. So you have a gap lining up with an order block. You can put your butt. This trade is gold, right? Boom. Comes back. In essence, it liquidity hunt, and in 1 week, boom. So that's an example of a momentum gap. So we're just going to add that to the list, momentum gaps. Now, number 5. I did not discover number 5. This is not even my words. I am not going to try and change them. I learned this from a trading mentor of mine. When I say mentor, not somebody I know personally, somebody whose material I used to follow a lot when I first started trading, who was really, really, really very instrumental in helping me to understand institutional order flow. He calls them fair value gaps, right? Fair value gaps. I'm not going to try and change it. That's what he calls them. Now for this, I'm going to have to show you a couple of examples of what a fair value gap is, because it's not as easy to spot as a momentum gap. Momentum gaps are obvious. Just look for a hole in price. Fair value gaps require some level of intelligence or experience, not intelligence, experience to spot. So let me give you a couple of examples. They usually form at reversals, where price runs through a level so quick. Here, for example, price runs through the level so quick that it doesn't have the chance again to trade efficiently. Now, this is a bad example because this same candle price comes back. So let's not use that one. Let me find a clear one. Aha, this is it here. Look at this here. One candle. Price runs away so violently. This here is 66 pips. It's a daily chart, but this is, it clears the engulfing by 66 pips in one candle. There is a fair value gap here because between here and here, price hasn't done any trading. In essence, any orders in this level have not been allowed to be traded efficiently. You will usually see it return to close the gap. And so here it closes the gap the very next candle. And that's usually what happens. One candle smashes through it so far, it'll close the gap the next candle. However, let me see if I can find some examples. There are times where the gap is not closed for several candles. Let me see if I can find one there. Right, let me see. Okay, let's use this one here. No, that's a bad example. That's a bad example. That's a bad example. My brain is tired. Okay. Let me see. I think I might have one for you. Okay, let's look at this now. This is an example. See the body of that candle there? When price reverses and runs through it, it runs away real quick. By the time it gets down there, it hasn't come back into that level for several 4-hour candles. Even now, this is a case where price just reverses. But even if price was going to keep going lower, 7 times out of 10, you could draw that line out and bet it'll. And notice what happens when it comes back there. Even though it keeps going further up, when it comes back there, you see that it reacts to that level precisely because there is a liquidity zone or liquidity profile there. So in a situation where you're expecting price to keep going further down, if you threw your Fibonacci on that, as you can see, that coincides in the area of deep or high premium between 61.8 and 78.6. You know that this is a high probability. When price starts coming up from here, you are almost certain that it will get there. Why? There is a fair value gap in that region. Now, what it does when it closes the gap is anybody's business. It could reverse, it could still keep going the other way, but you are guaranteed that that will happen. And so you have 183 pips to work with. So that's a fair value gap. Let's keep going. Well, first of all, let me stop here, or let me pause here and give you a chance to ask questions, because I know this is a bit heavy, but any questions so far? Any questions so far? I'll put that on the screen. Any questions so far? Okay, let's see. Yeah, Priscilla. So yeah, Almost a guarantee, yes. Keyword being almost. Okay. Reggie says need to chew on the fair value gap. Okay, I'll go over it again. Okay, fair value gap. Okay, so let's go over the fair value gap again. I'm trying to find a real good example of one. Let me see. Let me look in the Swissy. Let's see if I can find one. Right. Okay. This is a short-term one here. Price is going up. Right? It changes that. 1 second. No, that's not what I was looking at. Price, where was I? Okay, so this is I spotted a perfect one. This one here. Look at that, right? Price is going up. And then it changed direction and ran through that level. See, it just ran through it. It didn't spend much time there. In one candle, it ran through it. It came back up and met it, but then it ran again. So the fact that it, look at this. Let me pull that out. This candle here, this Marabuza, second, let me get rid of that. This Marabuza here runs through that price level completely. In essence, between here and here, there is an inefficient price zone. This, in essence, before that candle forms, all we know is that's inefficient. The market laws of supply and demand are going to mean that at some point very soon, price needs to go back and trade through those price levels, capture those orders efficiently. Now, the very next candle, it does so. The very next candle, it does so. But still, in the future, it means this candle here did not capture all that efficiency. It has to go back into it. And you see, it touches it again 3 more times. This here, this level there, is a fair value gap. We need price to come back and close that gap in the future, and it will. Now, you may not have noticed, but there is, 1 second, who's sending me a comment? Yep. Marabuza is almost wickless candle. So it comes back and it closes the gap. And as you can see, it spends plenty of time in that gapped area before it finally goes. And there you have it. Then when it's satisfied all those orders, it then runs away. This is another example here. Look at this. Look at this candle here, right? See this there? Exactly a gap here. The close of this is actually both a fair value gap and a momentum gap. The close of that candle and the open of this one, there's a gap between them, but also price runs so far away from it that there needs to be for the efficiency to be maintained of the orders. Price ran away too quick from here. There are unfulfilled orders here. People who didn't get a chance to get in certain trades with deep order books. Price is going to come back there to satisfy. And so this here is the fair value gap profile. And so all the while price is doing this, we're not too excited because we know very soon it's coming back to fill that area there. Does that make sense, Reggie? Like I said, I do know of all of them, this is the least obvious one. So it's the one that needs to be chewed on the most. But go through your chart. If you look clearly, you'll see it all over. This is another one here. Look at this, right? When price runs away from there, it can't keep going down fully because there's an inefficient level here. It's a fair value gap. I think I might come up with a different name for it because the word gap, I know, trains your mind to see a hole. It's not a hole. It's just a space or a level where price ran through inefficiently. So I'm going to go chew on what name to give it to make it make more sense. But for tonight, just take it as a fair value gap. That there, while all this is going on, your stochastics, your MACDs, your Bollinger Bands, your RSIs may be telling you price is going down and you wonder why won't it go yet? It's not going yet because there's a fair value gap that has to be filled. It's filled here and here a second time, and then you see the real move. This pattern happens often. Very, very often. And it's something I incorporate into my trading. So fair value gaps. Does that make sense, everybody else, before I start to round up for tonight? Just let me know if that makes sense. Number 6. Which is a super one. Stop hunts. So I'm going to call them stop hunt market structure breaks. In essence, a market structure break that started as a stop hunt. This here is the MacDaddy of them all. It's like Lord of the Rings, one ring to rule them all. This is Sauron's ring in Lord of the Rings. Especially when you see it on a 4-hour or a daily chart. Let me give you an example. Look at this here. I'm going to draw that line out. When that starts forming, you have no clue what's coming afterwards, right? All you know come on. All you know is that here a low forms, right? And then here that low is blown out. For all you know, price could keep going south. So you don't know anything better yet. However, when price turns around and gives you a bullish market structure break, right? This here is the most powerful signal in foreign exchange. This here, right? If you can learn to spot that, your life will change. This is the most powerful signal in trading foreign exchange or any other asset class. Stocks, shares, Bitcoin, Ethereum, whatever. Why? What this tells you is at this low right here, right? Let me put this here. This is a market maker low. This low right here. Put that in. 1 second. This is a market maker low, or as I call it, I call them beachheads. A beachhead is a term from the military where when an army is about to invade or is being invaded, whatever it is, they make a stand. This happened at the beaches of Normandy in the Second World War, where the Allied forces made a stand at a beach, and they dug themselves in the sand, and they said, if we die, we die. The enemy is not getting past here. We're making a stand here. We're not retreating any further. We're going to hold this position at the cost of all our lives. Bear in mind, a market maker is probably trading in billions of dollars, maybe at least 100 million thereabouts over the course of a day. They don't like to lose. Market makers don't like to lose because they have huge amounts of money riding. So Reggie, what you did with your chart today, that's how market maker thinks in the opposite way, in that they're going to hold a line in the sand and say, I am going to defend this position. So you hear me talk about a high or low being, or a level. What am I doing? Insert text. Being defended. If you can spot a defended level on a chart, then you can trust your trades at that level. This here means a market maker engineered this move. They are not going to give up that level without a fight, right? They're not giving up that level without a fight. Therefore, this zone here, let me show you this. All the way from the last order block, this one here, before that was blown out, to the bottom of that low, that's a super order block in the future. It is very unlikely to be breached anytime soon. If I zoom that in, so let's see, the first time, let me zoom it out, sorry. So this leaves, comes back one, comes back almost. It blows out that liquidity, but it comes back here again, and notice it runs again. This right here is your money maker. And so this is what I refer to when I talk about a stop hunt market structure break. This is a sign that there was a huge amount of liquidity there. When price returns there, you expect it to either reverse or at least consolidate. So I'm going to give you those 6 for today. I'll carry on with a couple at our next session, but this is irrelevant if you don't know how to make it work. So the question then becomes, what do you do with liquidity profiles? So Reggie, for instance, to use your the example of your strategy, if your signals on your stochastic and your Bollinger Bands are lining up with price hitting a liquidity profile, then you can trust them. So how do you use a liquidity profile? Well, a couple of ways. Let's see how to use a How to use a liquidity profile. So we'll call them an LP. Liquidity profile. Put this up here. So we have room for this. So we're going to end tonight with how do you use a liquidity profile? Because it's all well and good knowing them. How do you use them? Number one, to form trade scenarios. If you haven't watched the video where I talked about the elements of a trade plan, please go. I think that was last week. Please go watch it. Your trade plan has to start at the technical level with the scenario, meaning I'm expecting something to play out in price on a macro level. That will usually be an LP. For instance, when I taught you guys how to do pre-week analysis, let me see, which one did I use? Nope. Right, so when I taught you how to do pre-week analysis, actually I know what to use. This one here. One second. No, I'm for EU. Right, so notice how I framed my analysis on a macro level using LPs. The gap there, right? The market, the order block there, the pivot level here. A return to the order block, I expect price to bounce. So I am expecting this week in EU to be bearish because of this liquidity profiles that I started tracking on a weekly time frame. Then I drop down to a daily time frame and I do the same. Pivot point. So I'm expecting price to get there, or I thought it might get there initially because of this pivot point here. If it doesn't, that's fine. Look at this level here. Look at where price formed this high this week. Right? It's another pivot point here, there and there. Well, look. That's what it's responded to. So I don't need this. Sadly, I didn't get my engulfing here, so I'm not sure how well I can trust this. But anyway, I've also got this level down here, which is another liquidity profile. And so I kind of expect over the next few weeks price to do this. I'm forming my scenario using liquidity profiles. Let me know if you can see that, if you understand that. That the scenarios I'm forming them based on higher time frame liquidity profiles. Type I understand if you get it in the comment section. If you don't, type I don't understand. So number one is to form trade scenarios. Number two, is to anticipate significant price levels in advance. In essence, I was not interested in trading today. I decided to take today off because I looked at my chart in the morning and I realized that in EU, let's come back here. Where's that EU chart? This one. I initially thought I was going to get that. And so I said, today, until I get there, I'm not trading. I was expecting or anticipating that level there. I didn't get it today. I may get it tomorrow, because that's the body of these 2 daily candles. This reacts to it. There's a pivot level there. If I refine it even further, I could use that day there. It still works. And so until price gets in that ballpark, I told myself no trade. So I'm anticipating that level, although this one here would satisfy it. But I'm also, the other reason why I'm anticipating that level is because of this liquidity here, where I'm expecting a stop hunt. Okay, let me explain that for those who said they don't understand. Cool. Let me explain. Let's go back there. To anticipate significant price levels, meaning the liquidity profile will tell me, like in this case here, that there is a, so I'm saying at the moment that 11366 is a significant price level. So this line here is telling me that 1.1366 is a significant price level. Why? One, there is a pivot, an organic pivot or price action pivot from months ago, almost a year ago or over a year ago. Two, there is an order block here. And three, move that, delete that for now. Three, there is a stop hunt at that high here. So liquidity profile 1, delete, 1 second. Liquidity profile 1, this high here. Liquidity profile 2, this mark order block there. Liquidity profile 3, these pivot levels. 1, 2, 3, 4. That tells me that that level there is likely to be significant. As a result, I am waiting for price to hit there. I could be wrong in this case, but I'm waiting for price to hit there. And so when I woke up in the morning and price was hovering around here, I set an alert on my MetaTrader 4. I'll show you guys how to do it. You can actually tell MetaTrader to send you a text or a notification on your phone. So an email, sorry, or a push notification on your phone when price hits a level. I can play football. I can take my wife on a date. I can walk my dog. I can hang out with my kids in the park. When price hits that level, MetaTrader will send me an alert. I now know to start stocking a trade. So using 3 liquidity profiles, I am waiting for price to hit a significant level. Okay, so Natalia gets it now. Does anybody else get it now? Cool. So that's the second way you use liquidity profiles. The third way, nope, Reggie, alerts are free. They're absolutely free. I'll show you how to do it. I'll show you guys how to do it tomorrow in our closed session. Absolutely free. So the third thing you use a liquidity profile for are trade signals. Now, before you take a signal, you need to form a scenario. For instance, on the weekly, I formed the scenario that I'm expecting price to come back here. That was my scenario. I'm just realizing actually that there means this level has been hit once already. So it actually doesn't really need to go there now that I'm looking at it on a weekly. That has, anyway. So my scenario suggests to me price is going to go down using 1, 2, 3. Pivot level 1, market gap 2, order block 3, order block 4. That scenario tells me price suggests price may be going down. On the daily, I was waiting for a significant level. I thought it was going to be that one. I do know this is relevant. So you could argue the level has been met or it's about to be met. The signal is if price goes into this order block and comes back out with a bearish engulfing, that's my signal. Ready to use yours from earlier today from your system. If you see your stochastic crossover with a Bollinger Band at a liquidity profile, or better yet, more than one. So 1, 2, 3. 3 liquidity profiles there. If you were to get your Bollinger Band reaction and your stochastic crossover in that region, you can trust it. Because it's not just the indicators coming up with stuff themselves. They're showing you a liquidity profile. Something is likely to happen at this level anyway, because there's liquidity there. When your indicators give you a signal, or your price action principles like engulfing, for instance, if I see a 15-minute market structure break at that level, look at this. Give me an example. So this is a 15-minute market structure break here, right? There was a 15-minute market structure break there. What drove the market structure break was the zone formed by 1, the pivot level, 2, the order block, and 3, well, it didn't get there. But 3, even if it didn't get above that high, there's still another order block here. So you have 1 order block, 2 order blocks, 3 pivot level, and potentially 4 the intermediate high. You can then trust this signal because it's happening. So this is an example of a price action signal. And a market structure break is a price action signal. A stochastic or a MACD or Bollinger Band is an indicator signal. Whichever of them you use, price action or indicator signals, when they happen at these levels, you can trust them. Boom. Trade signals. Number 4. You can use them to frame your risk. Many times you will see me put my stop loss on the other side of an order block. I'm using it to frame my risk. In essence, if price leaves here, I am believing it was this order block that caused the reaction. Therefore, if price goes back and passes that order block, the reason for me taking the trade is now over. I believed it was this order block that drove the reversal. If price blows through the order block, there's no point taking any further losses, right? I'm just going to get out there. Once it goes there, now sometimes it will spike and come back down, in which case it was a stop hunt. But that's just the way it is. In which case, then you might want to draw out your order block from the level in the past. Whatever it is, you use it to frame your risk. In essence, where to put your stop loss and how to calculate whether or not to enter the trade based on your money management. Is it 4-1? Is it 5-1? Is it 6-1? So to frame your risk, number 5 is as a profit objective. So for instance, if you got in this trade down here and you were going up and up and up and up and up, if you knew that from the past, look here, there's another block there on the 4-hour chart. Can you see that there? So this is an order block from June. The moment you got into the trade down here and you're balling. The moment price gets there and reacts, get out. Because if you've met 4, 5, 6 to 1 and you run into an opposing liquidity profile, it's a sign that it may be time to end your trade. And especially if you run into a liquidity profile from a higher time frame. So if I'm trading on the 4-hour level, 4-hour chart bullish, and I run into a bearish daily liquidity profile, a daily order block or daily pivot or daily momentum gap or daily fair value gap or daily market structure break the other way, it's time to get out of the trade. So to frame your profit objectives, and 6, your money management. That's obvious in essence. To calculate, so for instance, if you're calculating your risk based on your order block, then you're going to calculate your risk to reward ratio in multiples of that order block to know if that trade is worth your while. And the final one which seems very obvious and but when you chew on it as you get more matured as a trader, you'll understand what I'm putting on the list is to determine market structure. Now, we crudely define market structure with Tuckbear and myself last week because you were beginners, as whether or not price was making higher highs and higher lows or lower highs and lower lows and lower highs. That's a crude description. The more exact way to define market structure is to ask the question, is price respecting, one second, what's going on here? Okay, something there. All right, let's find one where there's nothing. Okay, we'll use this one. Is price respecting bearish liquidity profiles and violating bullish liquidity profiles? Then it's a bearish market structure. In essence, if all the profiles that are being respected are bearish, let me see if I can find something here. Let's see. Okay, so between here and here on your chart, you would argue this is bullish, right? Especially if you go between here and here. So let's look at the profiles. There's a low there. It was respected. So bearish, in essence, bullish profile, liquidity profile respected. There was a high here. It was violated. That's why you had a market structure break. So you violated a bullish liquidity profile. You come up here, price comes down. There's another block there, respected. On its way, it violates a high. So these are two examples where it's respected bullish liquidity profiles. It's violate, because a high should be a bearish liquidity profile. A high should send price the other way, but it's violated. But the order block is respected. This is telling us that we have a bullish market profile or market structure. The reverse is true. Order block respected. Low violated. Right? Price runs down, comes back. So fair value gap respected. Another low violated. Price comes back. Another fair value gap respected. 1, 2, 3. Another low violated. Not only is it violating the lows, along the way it's violating lows, it's also violating order blocks. It violated that bearish order block. Dip beneath it. Then here, it violates another bearish order block here. Dips beneath it. All the way up to when it gets here. So in this leg of price, we have bearish market structure. These ones are obvious. There are times you will look at a chart and you will not be clear. Is this bullish or bearish? You start plotting the liquidity profiles, and what was unclear will become clear. Okay, it looks like it's unclear. However, it's respected the last 3 bullish profiles and rejected the last 4 bearish profiles. Therefore, it is bullish. And then after that, you will see a wild bullish move. This number 7 will only become valuable to you as you get more experienced. You can predict a breakout in a tight area by studying which directions profiles are being respected over the other. And so even before everybody else can see it, you can predict a big move in one direction. We've been going for exactly an hour and a half, 90 minutes. I want to keep the teaching sessions to no more than 90 minutes. Any questions? I'm going to stop there for today. Any questions? Any questions? And I know there's a delay, so I'm going to give a couple of seconds or 30 seconds to see if anybody has any questions. As usual, go back and watch the videos over and over again, make notes, and try and spot the same things in your charts. Okay. In the absence of any questions, we are back tomorrow evening at 9:15. It's going to be a closed forum tomorrow, so only people who get access are registered students, and we're going to take the time to really delve into your own, or how these things apply to you. So tomorrow we're going to do a few questions and answers. We're also going to work with you by screen shares to decode some of the principles we've been teaching so far. So especially for the beginners, because we're going to focus on beginners tomorrow. So if you're an experienced trader, you're welcome. You will learn something that is very valuable to you. But just bear in mind that if it seems like we're going very slow with some stuff, it's because it's primarily geared towards beginners. Come with your questions tomorrow. Go through the material over the last 2 weeks and make sure you have questions or things you need clarity on to make the most of it. And then Thursday, 11 a.m., another beginners forum, an advanced forum at 9:15 on Thursday, and our final live chart analysis on Friday. I wish I had time to do some more live charts, but we already did some this afternoon. So I think what we did this afternoon should already prepare you for tomorrow in the markets on the pairs we're watching, especially the EU, the GU, and the UCHF. All right, guys, it's been live as usual, hanging with you. You're the best class in the world. I'm looking forward to you progressing further on your journey and becoming market breaker traders. Take care, have an amazing week, and see you soon.